Hey guys, we're back on this Thursday, April 30th. We're going to go over our trades for the day. We did have some news yesterday. As you know, it was Fed Day. We do not trade on Fed days. Although we did have some correlation positions, which was not a big deal. And then last night, so we had a total of 5 trades between last night and this morning, liquidating some positions. Picked up 11.1 pips, adjusted for size. Let's see. Let's first talk about the Fed real quick because we got to go over those 5 trades. The Fed did nothing. Obviously, we knew that was going to happen. It was all about their statement. They seem to indicate that interest rates will rise later rather than sooner. So it seemed like they took the June time frame for raising rates off the table, looking at September or later of this year. Of course, they had a caveat with that, saying it all depends on the data that's about to come out, going forward for the month of April and for the month of May before they make a final decision in June, obviously. But as we've been saying in these videos, and the economic data for the month of March has just been absolutely horrific. The other data point that came out yesterday morning, which we totally could not trade with, was GDP numbers for the first quarter, which missed miserably. It was estimates on Wall Street were for a 1% growth of the economy for the first quarter of 2015. It came in at just 0.2%. So a complete slowdown in the economy. But we've been saying it all along. So if you've been listening to these videos, you're not surprised. So let's go over. We had 5 trades. Like I said, we pulled out 11.1 pips. Just want to show you, if I can get it here, a chart. Where is it? Here it is. All right, so this is a correlation trade. I mentioned that we had some correlation trades. What you're looking at here is the Australian dollar, Japanese yen to the euro to Japanese yen. The blue line is the euro to yen, and the chart itself with the candlesticks is the Australian dollar, Japanese yen. Now, these two pairs are very highly correlated. I believe for the past year, this is a yearly chart, for the past year, I believe it's a 98% correlation, almost 1-to-1. So that's why you'll see many times they're right on top of each other, okay? But at times that correlation gets thrown off for many different factors: the local economy, of one of the countries, interest rates of one of the countries, many different. Just a big buyer or a big seller in a certain pair could throw off the correlation. Okay, and you'll see how the correlation gets wide. It was back here, May of 2014, how wide it got, and sure enough, it narrowed. So when it's this example back here, May of 2014, you would have been shorting this euro to yen, which is the blue, and buying the Australian dollar, Japanese yen, betting that or calculating that either they're both going to move in your direction, or at least one of them move in your direction and catch up to the other. And in this example, basically, that's what happened. Depending on when you put this position on, but you can see they both came right down they both touched by June of 2014. Sometimes it happens within a few hours. Sometimes it happens, a few days, and sometimes it happens in a few weeks or a couple of months. In that example there, the actual touch happened in a couple of months. So you would have profited nicely, handsomely on the euro to yen. And depending on when you put it on, the long of the Australian dollar, Japanese yen would have been relatively flat. So you would have had a nice profit. This we wanted to show you because when we put the position on, we had a big spike here in the Australian dollar, Japanese yen. And although this was spiking up as well, the euro to yen wasn't spiking up nearly as fast, giving you this spread in correlation. Now the spreads can be on this one can be as wide as about, I believe it's about 500, 600 pips or so. This at this time was about 220 or 240 pips. So we didn't put on an entire position. We put on about 20% of what we would normally put on. Or I should say we put on about 50% of what we normally put on, but a 20% size of our normal scalping trades. because if the spread widened, we would put on the other half. And we could ease into that or put them on all at once. So if the spread did get to, say 455, 550 pips, we put the other half on, reducing our cost on both sides. And then when they narrow, you're going to make a killing. As this one turned out, we closed it before they actually touched. They still haven't touched. But if you're still in this, you're rocking it because it's been coming down hard today. So let's go back to, let me see if I can get out of this. So we'll show you what we did. On the Australian dollar Japanese yen, we were short this 95.326. And we covered it. It came in nicely. Within a few hours, it came in. Probably a couple hours. And we picked up 25.6 pips on it. Covered at 95.06. Now, the euro to yen is what we had the correlation with. And we were long that at 130.47. We got out of that with a 16.5 pip gain. Size adjusted 3.3, as was the Australian dollar Japanese yen, size adjusted 5.1. So nice trade there. Then we had another correlation trade. We don't have that on that other software to show you, but we had another correlation with US dollar, Canadian dollar to the US dollar Japanese yen. And in this one, US dollar, Canadian dollar, we went long 1.20134. Happened again in a few hours. We picked up 15.1 pips. Adjusted for size 3.0. And the US dollar Japanese yen, we were short this 118.940. In a few hours we covered, picking up 16.4 pips or 3.2 adjusted for size. So what correlations trades do is they greatly reduce what I like to call directional risk. So as an example, on this one here, we'll use this one, US dollar Japanese yen. Let's say we were just going to only trade US dollar Japanese yen, and we were going to go short, but not just only this pair. So we're not going to have the US dollar Canadian dollar. Well, it's not a correlation trade. So in this example, if it came in and you cover, you'll make your profits. But let's say we shorted over here early this morning. This thing, that's directional risk. It's totally going against us, right? Now, because you only have one pair on, right? Now, if we were putting on a correlation trade at the same time we were using US dollar Japanese yen and going short that and going long US dollar Canadian dollar, during this spike of the US dollar Japanese yen, which we were losing on, the US dollar Canadian dollar, we would be long and we'd be gaining on that. Now, I don't know, I haven't calculated it out exactly what the position would be right now. It might be down a little, might be up a little, might be relatively flat. I don't know. But I'm just trying to make a point where it's reducing the risk of a directional move, or directional risk, if you maybe it's a lack of a better term, but that's what I like to call it. So you don't get correlation trades every day. We just this past week with the increased volatility levels between GDP numbers and the Fed announcement. I believe Bank of Japan had an interest rate decision. I don't know if Australia, they may have had an interest rate decision. So you had a lot of action this week. So that volatility, all that news creates added volatility, and that added volatility could happen in one of the pairs of a correlated two pairs, right? So it gives you those opportunities. We may go several weeks or a month or so without seeing another one. I don't know. But this week we've had three. We had those two, and we also had an Australian dollar, US dollar to the pound to US dollar, which we closed some of, but we still have a piece open, so we're not going to go over it until we're completely out of it. But it was a nice profitable trade so far. We got out of 75% of the position, so the other 25% of the position we still have, and if we're down on that a little bit, but overall it's a profitable trade. So we'll see how it transpires. We might be in that 25% for a few days, a week or so, something like that. So if you don't know correlation trading, check it out. It's when you get the opportunities and you know how to do it, you should just totally jump on it. I would advise not to use a lot of leverage. We don't use much leverage at all when we do correlation trades. Reason being, you could be stuck in it for a while. It's going to be eating up your buying power if you want to take other trades. If you don't want to take other trades, maybe go a little bit heavier with your leverage. That would be my advice to you on that. And also be prepared to be in a position. Again, it could be hours, could be days, could be weeks, it could be a couple months. So and while it's in it, you may be seeing a big loss in one of the pairs or even both pairs. But you have to have the confidence that they're going to come back in with the correlation. There's a reason why they're highly correlated. If you're going to look at the correlation, you're not going to do this on an hour chart, a 15-minute chart, or even a 4-hour chart. You're going to use a daily chart, and you're going to look at the chart for over a year, and you're going to look at the correlation of those pairs throughout that year. And you're going to stick with the high ones, 96, 98, 90%, something like that. So you'll see, and you practice with it. And then the last trade we had was Euro US dollar, which we were short this 1.08420. Went against this. We only had 5% of our normal size. We would have been 10% of our normal size, but as you know, at the end of every month, we like to cut our size in basically half on a scalp or a swing trade. Correlation trade really doesn't matter. And it went against this consolidated. Once it started to break out of this consolidation, it was your clue to cover, to get out. It could have broke down to be a profitable trade, but the fact of the matter is it broke up. So we lost 69.2 pips or 3.5 pips adjusted for size. So wasn't too bad of a loss on that. So overall, like I said, 5 trades, 11.1 pips. We'll take it. A decent way to. Not a great day, but it's not horrible either. So that's it. We're going to wrap it up. If any signals come out, they'll be coming your way. Let's see. And that's it. Have a great rest of your day, and we'll be back. We'll be back tomorrow, assuming we get some action. Nice, guys.